good. Nirmal Jain of IIFL joins in to talk about whether things could get worse from here. Nirmal, good morning. Are you feeling cautious about the market given the news flow that has come up of late from both global markets and from our internal macros?
Yeah, I think one has to be very cautious in the market. I mean, today market has moved up a little bit because global markets are better and gold imports had fallen, and also RBI and SEBI and other regulators had taken certain steps to help the rupee. I mean, the margin on the currency contract also has been raised. But these are all temporary measures. They don't solve the structural problem. And I'm a bit cautious and concerned for two reasons. One is emerging markets in general have not been doing too well. In fact, in the last 3 years, if you look at the outperformance of developed markets vis-a-vis emerging market, it's a whopping 55%. So most of the global investors are waking up to this complete disbelief that growth has been higher in emerging markets. Still, developed markets have done so much better in dollar terms. So money is flowing out of emerging market, and that's why we are seeing that ETF and index funds are selling. And on top of that, India's political situation is not very encouraging. I mean, foreign investors are not very enthused by the way our government is absolutely not at all worried about grim situation that is there on the ground. So still we are not approving FDI proposals, even in pharma sector, even elsewhere when rupee is so precariously poised at this point in time. So although there was an opportunity, because India's growth story is still better than say Brazil or China or Russia for that matter, but I think it's being frittered away by complete policy paralysis as well as indecision at government level. Government is just preparing for elections, as we have seen, and food security bill is another problem. What will happen with this, as FM tries to contain the fiscal deficit, plan expenditure will further come down. And that means that investment cycle, which has been has collapsed for last 3 years, will continue to remain so. The problem there is that we just saw employment numbers. There's no new employment has been generated in last 1 year, and India is adding almost 12 to 15 million people to workforce every year. So all these things don't augur well, and unless government does something decisive very quickly now, because I think sense of urgency is something which is missing at North Block, and we have an opportunity to control this damage, contain this, and make sure that we don't get hurt as much as other countries in the emerging markets will be. But at this point in time, one has to be very cautious and watch all the developments internally as well as on the global front very carefully.
Nirmal, good morning. It's often difficult to exit from our market in a rush as well because of the impact cost that people face, on their positions. Is it your sense that this outflow situation is going to carry on in a consistent fashion and for much longer, where the market keeps seeing these steady outflows?
See, on a debt front, there has been $6.5 billion outflow in last 2 months, last 1.5 months, and which is higher than the net inflow in last 1 year. The total FI debt is about $50 billion, out of which maybe 6-7 is already redeemed. So even if you see some redemption there will be tremendous pressure on the rupee, and total external debt is about $390 billion. But this kind of a situation for the rupee is not good. Even the other lenders, whenever it matures, they may not renew the debt, and that is where the risk is. In equities, we had an outflow just about $1.5 billion. The problem is that even if there is a small outflow, the situation is very fragile, and that is why we need very desperately, there are certain measures which actually change the sentiment of foreign investors. So even if there's a couple of $1 billion more, I think we are very helplessly poised because there's no money coming from domestic investors. So if there is a small outflow on equity front or a continued outflow on debt, then our currency is looking very fragile, and that is the main cause of worry.
What do you do with the call on the rupee now, Nirmal? It's still at 60 plus despite the measures which came in from SEBI. Do you see that inflicting more pain on the general corporate sentiment and market sentiment?
Yeah, I think so. And it's a 60, 61, and whatever measures we are talking about, they are technical. There's no fundamental structural thing that we heard from the government that they want to get more FDI, or they want to do something which is, say, import dumping duty to make sure that wherever we have spare capacity, at least we don't import we are not seeing anything which will promote exports or contain imports in any meaningful manner, or also encourage flow of capital which is a little longer term, which will give some time for the government to get import-export balance or current account deficit right. So all these, RBI and SEBI steps, they are all technical. They have very limited, life in terms of effect on the market. If the fundamental problem is not solved, then again we see that slight problem in global market, and our currency again, starts tumbling. And that is a very scary situation, because from here, if rupee tumbles further, then there is the entire confidence of investors can be shaken. And as we know, that markets are basically all hinging upon the investors' confidence.
Have you changed your view on how much by way of rate cuts one can expect from the Reserve Bank in the second half of this year, Nirmal? Because that was one hope that the stock market was clinging on to, and the bond market was doing quite well on. But have things changed on that side as well?
I think so. Now the rate cut hopes are also diminishing, because RBI's stance has been very clear that if inflation is high, then will keep the rates or the monetary policy tight. Now the situation is that with the rupee's depreciation, India is in a very strange situation, because on one hand, productive capacity has not been created because of various things, which is high rate and investment sentiment, and on the other hand, government is doling out a lot of money in the consumer's hand, particularly rural and also urban poor. So there's a huge consumption demand and no productive capacity coming up. So either that leads to import for consumption, or that leads to inflation. So in this kind of a scenario, inflation will remain high despite low growth, and whatever RBI stance has been, it looks like that they may refrain from rate cut further, or they'll defer it. And therefore the rate cut hopes are also now getting, in terms of, as I said, that the rate cut may not happen as much as we thought earlier.
Given all that you just said, Nirmal, what are the fears that the market might settle into a lower range during the second half of this year and not make it past that 6200 level which people were talking about earlier?
I would say 50-50, but on the positive side, we should just look at few things that can go for India. One is, India has been a huge importer of commodities. So when the commodity prices fall, commodity exporting countries like Brazil, South Africa, Indonesia, they get impacted, and India's corporates become a beneficiary. Also, the lot of negativity has already been factored in, but if government can move positively and encourage FDI investment in the last 1 year of this term, then the positive sentiment, because the other countries are also, or other investment destinations in the emerging market, they aren't too great for investors. So by default, India can get some money. And therefore, I would say there's a 50-50 chance that the market may further go down or will remain at these levels. But on balance, it looks very unlikely that they will rally from this, at least till elections, because the political worries will remain on top of investors. So even if things improve a little bit, they may not sell, but they will wait before buying in any meaningful or sizable value.
Nirmal, always a pleasure. Thank you very much for dropping in.
Thank you so much.
Thoughts.